Hello my fellow freedom builders, and welcome back to the second video on the English channel here today. And moreover, I made one in Danish as well for the Danish channel. It's been a while since I've been doing 3 videos a day, but it is earnings season and I think there are important things to address. Earlier today, I did a video on Microsoft. Today, right now, it is the Alphabet, that is the Google main company. And we're going to have a look at if that is a bit of a better bet than Microsoft. As I said in the Microsoft video, I was not too fond of the pricing right now compared to the future earnings in Microsoft. So let's have a look at Alphabet and see if that is any better. We have the price earning that is in the 32 to 34 range here. So that is fairly good. We have the PEG ratio. If you saw my Microsoft video, you know that I mentioned the PEG ratio. And the PEG ratio is expected future growth divided by... is of course PE ratio divided by future expected growth. And I do like this number to be around 2 or below. And with Microsoft, it was something like 5.7, something like that. And here with Alphabet, we have 2.0. So that is a lot better just from that simple number. We can see the earnings quality is good. Momentum is decent and value is red here, but we're not looking too much into that right now. We can also see, as with Microsoft, the return on capital, return on equity and operating margin is fairly good. And there is a Altman C score showing us that there is basically 0 bankruptcy risk. And the analyst estimates are also saying strong buy out here. All right, the free cash flow is quite steadily growing, and I like that better than the one with the Microsoft. And you can also see here the interest coverage is insane, so there's not really any problem here as for debt and interest payments. So let's remember the 32 to 34 here and jump into valuations. And in valuations here, let's just pop it 1 year further ahead here to be able to compare it with the Microsoft. And as you can see, there is quite a steady growth here in the expectancy, 17 and 18. Let's put a third year on, just saying 10%. That's a bit lower than expected for these 2 earnings years. And then let's put a 34, which was the uppercase here. That gives us an expected growth in stock price at 67.1% over 3 years. Now, as you know, I do like to use this just as a main rule of thumb, because then I do like to say, okay, but what if the growth disappears here in year 3? And what if the price earning actually drops as well? How far down can we drop this before it starts to become a negative growth over these 3 years? And here we can drop it to 24. So basically, this is a better starting point. As far as I recall, the Microsoft was just about 40 in the price earning, and here we are starting at 34. So there is room for this to drop, and there is room for the earnings to just be 0 in the third year here. And we can even, if they keep it at 32, we can even have the earnings actually go negative, the earnings growth go negative, and still have a break even here. So that is something of what I like to see. So overall, I actually do like the Alphabet case better than I like the Microsoft case. Now, you can dive in depth into the product, the customer groups, the different sectors, and we can get all sorts of clever stuff out of that. What I do like to do in these short videos is just to look at the expected growth in the earnings per share and try to speculate a bit into what are people actually willing to pay in price earning. Because as I mentioned in the earlier video, with a price earning at 40, which was the one Microsoft started at, that equals a yield of 2.5% on your money. And even higher, well, 50, that gives a yield of only 2%. But people are only willing to pay that if they can see some fairly decent high growth rate in the future. Because if you are paying a price earning at 50 and they double their earnings next year, well then that equals that your yield is actually, instead of 2%, it is 4%. And if they can do 100% next year, your yield is 8%, and so on and so forth. So the quicker the growth in the future, the more likely people are to put a hefty price tag, and they're willing to pay a high price earning. So with this starting at 34, that is close to a yield of 3%. And if people should go down and say, no, we actually want a yield of 4%, well, then a price earning at 25 is more reasonable. And Alphabet can actually carry that. They can carry a 25 PE and a 0% growth in year 3 here, and still be at a break-even trade. So should I choose, and this is before earnings, so a lot can change with the earnings after close tonight, and with the guidance, of course. That will be very important, and I will have a look at that into that tonight. And I'll probably make a video tomorrow, a combination video of Alphabet and Microsoft, to see which guidance were the best and if that changes anything. But should I choose between the two of these right here, right now, I would probably go for Alphabet. I'm not buying any of them because I'm not buying straight into earnings. If we have a quick look here, we can see that it has just broken the top back from November 21. So had you bought it here and just be a buy and holder, you could have been sitting on 3.5 years or something like that of being negative, and then just scraping into positive now. So having a look at this, well, if we should see a retracement, it's not impossible for the stock to retrace down to this top level here and find some support here before it bounces further up. But the trend is fairly good since it bottomed out in January last year. So it has been going up for 13 months now. And well, as I said, should I pick between the Google, the Alphabet stock here versus Microsoft, I would probably go for the Alphabet. But that is just my opinion. You are welcome to have your own opinion. You should always assume that anything I say could be wrong, and you should do your own research, due diligence, and use your own risk management. That's all for now. It should be exciting to see the earnings tonight, and well, tomorrow we'll also see the US interest rate decisions, and we have some non-farm payrolls on Friday. So it is a busy week. Tomorrow I will probably also make a new Tesla video, and this is absolutely not to bash on Tesla. However, I have found something in the analyst estimate, something that they build their investment case on, that I think is slightly out of tune, to say the least. So you can have a look at that, and you can agree or disagree with me. Doesn't really matter. This is just for educational purpose. That's all for now. Talk to you again shortly. Bye.